Hey everybody, this is Coach D with TackleTrading.com here to talk to you about gross profit margins. Gross profit margins are gross profits divided by sales, which is equal to each sales dollar left over after paying for the cost of goods sold. Gross profit margin is a financial metric used to assess a company's financial health and business model by revealing the proportion of money left over from the revenues after accounting for the costs of goods sold. The calculation of gross profit margin is really simple. We get it by dividing the gross profits by the revenues. So gross profit margin equals the revenue, total revenue, minus the costs of goods sold, the cost of getting those goods and creating them and selling them, divided by the total revenue. And that will give us a simple metric that we can look at. And here's an example of Apple computers again, where we can see their profitability here. One of the metrics is gross profit margin. You can see that their annualized gross profit margin is 38.47, which happens to be down 1.5% year over year. So actually the gross profit margins for Apple over the last year have dropped a little bit, just about down 1.58%. And again, you can see where those numbers come in year over year. If you go back and look at the data over 2013, 14, 15, 16, 17, you can kind of see that they peaked out there for a minute in 2015, and then the ratios dipped a little bit for the last couple of years. By comparison, here's Microsoft, again, looking at their profitability and their gross profit margins. We see 64.52, which is a year-over-year increase of 4.56%. And again, you can see where they had a peak there in 2013. And again, from 2016 to 17, you see a nice pop in their gross profit margin. So again, we're just looking for the overall profitability of the company, the margins on their profits after you subtract away the costs for all goods sold.